I want to talk to you guys about a different part of us online. So I'm trying to make sure that I cover different features of the software so that you guys understand and know how they work. And I want to give you some more detailed information about how the different systems and different parts of the software work and what they do for you. Okay, what the benefits are. And so today I want to cover a little bit about risk-free trades. So risk-free trades, when I say that to people, maybe people outside of my class, sometimes people inside of my classes, I can ask, did you know that you can trade options and get a 100% guaranteed win? And people are like, that's not right. No, it's absolutely true. It's absolutely true. And that's what we're going to dive into today, because it's important to understand these concepts, okay? It's important to understand the concepts, especially when you're thinking in terms of other trades and how everything kind of works together. So when you're thinking about your strategies and the way that you want to profit based on different things, it's nice to know how the fundamentals all lay out. What makes an option pricing model work? How can you confirm those things? All that kind of stuff. And I want to get into those things over time. And so today we're going to cover the risk-free trades. We're going to look at the anatomy of a risk-free trade and the way that there's multiple ways you can do this, but the one I'm going to talk about today is using synthetic stock positions. So you can create an option position that is identical risk-reward and probability behavior as a purchase of a stock. And they call them synthetic stock positions. We have synthetic long positions, and you achieve a synthetic long position by purchasing a call and then selling a put. You get a synthetic short position by buying a put and selling a call, and then you have the same risk reward as if you went short the stock. After you establish a synthetic stock position, or at the same time that you establish a synthetic stock position, you can offset the synthetic position with the opposite stock position, right? So if I go synthetic long, I can short the stock. If I go synthetic short, I can go buy the stock, and I offset those positions. And that leads to arbitrage. Basically, you're buying and selling the exact same thing at a different price in two different places at the same time. And that's called arbitrage. Okay? If you can do that trade, if you can synthetically go long or synthetically go short and then offset it with the stock purchase or a short stock position, if you can do that at the same time and get a credit into your account, and you have a risk-free trade. You can't lose, right? And we actually have scans that, and we're not the only ones that have these scans, right? There's plenty of other people out there in the business that are arbitrage traders. That's all they're looking for is arbitrage opportunities. And they will scour the market looking for risk-free trades that have a slightly better rate of return than the current interest rates in the market. Okay? The currently available interest rates, you know, when you put your money in a CD in the bank, you're getting hardly anything right now. They give you a little bit, but it's hardly anything. Well, if you can have a 100% guaranteed trade in options that yields a return that's slightly better than that, why wouldn't you do it? Right? So interest-bearing accounts are, and this is why the risk-free interest rate is a part of the option pricing model. They are competitive products. So this scan right here, so if we're looking right here, we're looking at a synthetic short list. So this is where we create a synthetic short position in the stock. You can see at the top of the list here, we've got Western Digital, and you could sell, in this case, the 53.50 call for $239. You could buy the 53.50 put for 224, and the option you're selling is worth more than the option you're buying, so you're getting a credit there. And then you can go in the open market and buy 100 shares of Western Digital stock for $53.44. So it's even less than the strike price here. So we sell the call and we buy the put, and it results in a credit. Plus, we can offset the short stock position, the synthetic short stock position. We can offset it by buying the stock for a lower price than the strike price here. So that adds up to a little bit more money, right? So let's take a look at what this looks like. Here's the synthetic short of Western Digital. And you can see it's just like, this is exactly what the profit loss graph looks like when you short stock. When you borrow stock, you have an obligation to buy the stock back. If the stock goes up and you have to pay more for it, than you currently, than you did when you entered the position, that's not good. If you can buy it back at a lower point down here, that's great, all the way down to zero. So this is the profit loss here, and you can see the delta in here is -1. It's a short position. Stock goes up $1, we expect to lose $1 in this trade, and that's almost identical. But you can see up here that we're getting a net credit of 11 cents to take this position. 11 cents to take that position. Okay, so when we go out, and in odds online you can build the profit loss graph. You go out and you buy 100 shares at the current price of 53.44, and you can see our profit loss graph turns into a flat line, and it's all green. And that's because it doesn't matter where the stock goes in the future. If the stock goes up to 60, the call that we sold will call the stock shares away from us, the shares that we bought at 53.44, and it will meet our obligation to deliver shares at the strike price of 53.50. So we collect 53.50 from somebody. We keep our 11-cent credit plus the difference between 53.44 and 53.50. We get to keep that too. And it results in a profit of 17 cents guaranteed. If the stock goes down to 45, that's okay too, because we bought a put. If that happens, we exercise our option to sell or to put those shares to somebody at 53.50. And so if we put it to them at 53.50, we bought the shares that we have in our account at 53.44, and it results in a profit of 17 cents. And if both options expire worthless and neither option gets exercised, the only way that happens is if the stock closes right on 53.50. So we can go in the open market and sell our shares at 53.50. And we have our guaranteed rate of return, our guaranteed profit. So that is how, so this trade is called a conversion reversal. We're converting a synthetic position into the stock being delivered at the strike price of the options, and it's a guaranteed rate of return. It's an arbitrage play. We're simultaneously selling the stock and buying it for a different price, resulting in a profit. And this conversion reversal is what helps keep the balance in the market between the call and the put the same strike price. You have to have equal time value. If they have equal time value, then this conversion reversal doesn't really work out. But if they don't, if there gets to be an imbalance, then it creates an opportunity for a risk-free trade. So no matter what the stock price is when the options expire, no matter what it is, we're going to have either the option we sold is going to be exercised or the option that we bought is going to be exercised, and we're going to get rid of the shares even if the options have no value, no exercise value at expiration. That means the stock price must be at 53.50. And so no matter what, we're going to end up delivering the shares that we bought at the price of 53.50. Since we bought the shares at 53.44, that gives us 6 cents of profit in the difference between there and the price that we're selling them at. And then we also got a net credit when we took the option, when we created the synthetic options position. And so when we got that net credit, you add the two together and we have a total of 17 cents, which in this case turns out to a 6.24% annualized return. Okay. Now that's the example on the risk-free trade when we're synthetically short and we buy the stock. Okay, synthetic short and buying the stock. Now let's look at the other side. This is a synthetic long position. And I want you to notice something here. If I go back up here, right here, you can see the annualized return on all of these. The highest rate of return was 6.24%. A lot of these are in the 2 and 3% area. And when I go here to the synthetic long positions, look at that. Synthetic long positions are much larger in annualized return. Much larger. Much larger. And I'm going to show you why here in just a second. But I want you to notice here that these two names, Tilray and Beyond Meat, anybody in the community, have you noticed any comments from me in the past in the community on these two positions? If you've noticed anything that I've said about these two positions, then I'd love to hear it from you. Yep, Amity got it. Don't buy. These are on the stocks to avoid list all the time. These two are like perpetually on the stocks to avoid list. They're heavily shorted. Heavily shorted. Okay? And that can create a problem, and we're going to talk about that. So this is the synthetic long position. This is the equivalent of buying the stock. We buy a call, and that gives us our money to the upside, and we sell a put, and that gives us the loss to the downside. But you can see here in this case, when we do that, we're getting a $5.90 credit to buy the call and sell the put at the same strike price, at the 160 strike price. That's the difference in time value between these two options. That's a huge difference in time value. Huge. And that's what's giving us our really big rate of return on this trade. So when we go to the next slide, you can see if we could go buy or go short the stock, because we have the synthetic long position. To offset a synthetic long position, we have to sell short the stock. And so if we could sell short the stock at 160.31, the current price in the market, then we could collect that 590 credit, plus we could put the shares or give the shares to somebody else at 160. So we'd keep that 31 cents that we collect on there that we're going short the stock. So we'd get a total profit out of this that's at 621. 621 is the total profit that we would get on this trade if we could create the synthetic long position and sell short the stock at 160. This position, no matter what, same thing, we are entering a synthetic long position, and we're doing that for a credit. We're getting synthetically long at 160, and then we're simultaneously selling short the stock at 160.31. We're collecting 31 cents difference between the short and the long price that we're getting, and on top of that, we're getting a credit of $5.90 because of the imbalance in the options in the time value of the option between the put and the call. So this one gives us a huge annualized return. Humongous. So here's the potential problems with that. And the reason why we avoid Beyond Meat and Tilray. In order to sell short the stock, you have to be able to borrow shares from someone, right? And that's the first hurdle you got to overcome. Are there shares available to borrow? So I don't know if you all knew this, but there are limits to how many shares are available to borrow on any particular stock. There's a limit. Somebody has to have those shares and allow you to be able to borrow them. You might find out in the case of Beyond Meat and Tilray, these are heavily shorted stocks, and that's why they're on our stocks to avoid list. They're heavily shorted. So you might, if you tried to go and do this risk-free trade, and just about every time I've tried to do a risk-free trade like this, I've tried to put the order in, and I get the message back that says there are no short shares available. There are no shares available to borrow. Can't do it. Okay, so that's the first hurdle. You got to have shares to be able to borrow in order to do that position. Then if you can borrow those shares, a lot of the time when you short a stock, if the stock is easily borrowed, if it's something that's available all the time, then you hold cash in your account to pay for the borrow price. Okay, so you have a margin on that trade. If I sell short the shares at a certain price, and I have some margin that's being held to cover the cost to replace those shares. And a lot of times you'll actually get money to have that money in escrow as margin to get ready for the shares, if the shares are easy to borrow. If they're not, if those shares are not easy to borrow, then you're going to have to probably pay a rate to borrow those shares. Because if I had shares of Beyond Meat in my account and you wanted to borrow them, and I was thinking that, hey, I've got these shares that are probably going down because the stock's being heavily shorted, I'm going to charge a huge interest rate. If you want to borrow the shares, it's like borrowing from the bank. I'm loaning them to you. I'll loan them to you, but you got to pay me an interest rate, and known as the borrow rate. And if the borrow rate is so high, if those shares are in such demand to short, then the borrow rate goes through the roof. It goes really hard. It goes really high in price, and the cost to borrow those shares goes up substantially. And it can go up to the point where it offsets the profit potential if you're right and the stock goes down. So when those shares become very difficult to borrow, that's what allows this arbitrage play to break down. And that's why you're getting these really high rates of return, are because the The only reason the balance has gotten out of hand between the call and the put at the same strike price is because nobody can arbitrage using a conversion reversal or um, synthetic position to keep the balance between the put and the call. So that's how it gets out of whack, out of balance. So it becomes difficult. When they become difficult to borrow, the rates start to go up, and that's what allows for the imbalance in those positions. That gives us the opportunity to do a risk-free trade if we could get it done. We could get it done. Okay? So what are the conditions needed for a risk-free trade? So the idea that the time value should be equal on the put and the call at the same strike price is called put-call parity. And every option pricing model has to consider put-call parity. They have to consider it. So it's often a measure to tell if the option pricing model is giving valid responses. They use put-call parity to say, okay, is it keeping the balance between the put and the call at the same strike price? And that's how they can tell, one of the ways that they can tell that their model is giving a close approximation. So they have to consider that. So what you need for a risk-free trade to happen, you need the parity to break down. You need that put-call time value to break. You need it to get out of balance, because that's the exploitation that we can use to get a risk-free trade and use a synthetic position to offset an actual position, and then we can hit our risk-free trade. If the call bid is more expensive in time value than the put ask, you would use this to set a synthetic short position and buy the stock. If the put bid is more expensive in time value than the call ask, then you would use the synthetic long position and try to short the stock. So whichever way the stock is out of balance, or the options are out of balance, that's the way you would go with your synthetic position offset to get a conversion reversal. Both of these trades are called conversion reversals. Amity's asking the question, is there margin on a risk-free trade? Yes, there is. Yes, there is. You'd have to find out from your brokerage firm what the margin would be, but most often there's going to be, I have not heard of anybody say that there is no margin on a risk-free trade. It's you have to have the capital to buy the stock, and then you have to have the options to offset the position. Even if you have the stock, they'll have some kind of a margin requirement. There are almost always small imbalances, but when the rate of return on a risk-free trade gets higher than other guaranteed rates of return, the arbitrage play keeps options markets in check until the shares become hard to borrow. Synthetic short conversion reversals don't require borrowing, so the stock arbitrage tends to keep the parity in balance better than synthetic long conversion reversals. Okay, so did you get that? When you're doing a synthetic, you offset by buying the stock. And because that doesn't require borrowing the stock to get the arbitrage, that tends to be a safer bet if you can get the trade done, if you can get the prices that you want. It tends to be a safer trade, or an easier trade to get. Shares that borrow shares, if they get sought after for borrowing, then you got the interest rate that could hurt you, the borrow rate could hurt you, and the short shares might not be available. So it gets expensive. Okay? That's something you want to consider. So I hope this is helping you. If you're creating your own strategies and you see these kind of imbalances out there, these imbalances can affect the credit on your credit spread when you're doing them. the easy thing to say is you want to sell high volatility or you want to sell high time value and you want to buy low time value or you want to buy low volatility. And you can calculate implied volatility at the bid and at the ask, and these are all things that you can look at in the odds online to get the implied volatility at different bids or asks value at different month intervals. You can get a lot of that stuff out of odds online that other people just don't have. So arbitrage, there's a lot of players in the market, especially professional players that are arbitrage players. This is all they do, is look for arbitrage opportunities. There's a number of different ways to do it, and the conversion reversal is just one. Amity's asking, do you buy the stock when the options expire as well? So if you're synthetically long or synthetically short, you're going to, you want the exercise to take place. Okay? And when you exercise that position, then you are acquiring the opposite side of the stock position when you entered the trade. So if you're looking at a synthetic long position, then you're actually shorting the stock, and you would use the synthetic long position when the exercise takes place, as the time value disappears from that trade. When the exercise takes place, that's when you would be exercising to buy the stock and offset your short position. And that's what would happen at expiration. Yes. So if you put this position on all at once, you have everything in your account that will make it work. You don't have to. You're assuming that the exercise will take place, and that the option only has to be in the money. It has to be 1 penny away from the strike price. So the only time you'd have to watch it at all is if the stock price is really close to the strike price at expiration, because it can close right on the strike price. And so if you're worried about that, you can close your position right there and get out with the guaranteed rate of return.